Thank you for being on this video with me. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you understand the level of risk in the stock market through our proprietary market risk signals that are emailed to you every weekend as part of our weekly stock market-based newsletter, all for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for Tuesday, May 12th, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. Today we were down 2.05% on the S&P 500 and closed at 2870.12. This first chart that we're looking at is a one-day chart of the S&P 500 where each candlestick represents 1 minute of trading. And as we can see, we gapped up at the open, and then in just a few minutes we started to sell off and then got up to kind of that unchanged line for a good portion of the day. And as you can see, starting around 1 o'clock in the afternoon, we really started to sell off, and then the selling really started to intensify at 3 o'clock, and we sold off into the close and closed at the lows of the session. So this was a very bearish day. This to me is a reversal day. When you gap up at the open and then close at the lows and close off over 2% for the day, this to me shows some serious weakness. This was a reversal day. So in my mind, the question is, how low are we going to go? We are definitely starting to sell off here. So it's not if we are selling off, it's how bad is this sell-off going to be. Every sector of the S&P 500 was down today, as you can see here, with real estate being the worst, down 4.23%, and the best performing sector was consumer staples. It was only down 0.84%. Again, the S&P 500 as a whole was down 2.05%, and even technology, which has been the real leader in this rally off of March 23rd, was down over 2% today. Also, when we look at different capitalizations, we can see that the small cap S&P 600 was down 3.76% today. Mid caps down 3.69%. The Russell 2000 small cap down 3.64%. The Dow Transportation average down almost 3%, 2.29 to the negative. The equal weighted ETF for the S&P 500 down 2.51. The Wilshire 5000, which basically measures everything in the U.S. stock market, about 3,700 stocks, it was down a little over 2%. You had the triple Qs, again, the NASDAQ 100 down over 2%, S&P 500 down over 2%. And so, guys, there's weakness all over the place. All capitalizations, all sectors, we are starting to sell off here. Now, I had started to prepare these charts at about 2 o'clock in the afternoon, and so these annotations were actually drawn before we broke beneath them. We were still around 2910 on the S&P 500 when I drew this blue line at 2905. And the reason I put that there, and by the way, this is a 5-day, 5-minute chart, so each candlestick is 5 minutes of the trading on the S&P 500. But you can see on the 8th and the 11th of May here, that 2905 was our short-term support level on these 5-minute candles. And, you know, not too long after I drew this, then we broke beneath that and, again, closed at the lows of the session here. So, again, weakness on the short-term charts. And, again, same thing here. I had drawn this support line on this 15-day, 15-minute chart of the S&P 500. I had drawn this uptrend line on this chart before we broke beneath this. We were right in this area when I drew this line in preparation for today's video, and you can see that we have substantially broken this uptrend line on the 15-minute chart. Again, this is a 15-day, 15-minute chart of the S&P 500, and you can see that this uptrend line that we had intact since May 4th has now been broken to the downside. When we move to the daily chart, so this is a year-to-date chart of the S&P 500 where each candlestick represents 1 day of trading, and the lines, this is the 200-day moving average here, this orange line, the green line is the 400, and the blue line is the 500-day moving average. And you can see here over on the right where my cursor is moving, we have now once again closed beneath the 400 and 500-day moving average. And those of you that watch my videos on a frequent basis, you know that I've told you before that we're not in an uptrend, a real long-term uptrend, until we get at least above the 200-day moving average. The other thing that you can see here is this 200-day moving average is now sloping downwards. That is not positive. The 400-day moving average is pretty much flatlined, as well as the 500. So you can see that they had an upward slope to them over here back in January and February, as did the 200. But now the 200 is bent downward, and these things have at least flattened out. If not, you can kind of see the 400 is actually starting to go down a little bit here. So again, these are all bearish signs here, guys. So I would be careful. This market has been very lopsided. The things that have worked up to this point has been tech and healthcare and biotechs. That's kind of what led us off the bottom from March 23rd. But as we can see here, every sector is weak. Every capitalization is weak. Small, mid, large, everything. So I would be really careful here, guys, because it's not a matter of if we're selling off here. We are selling off based on what I'm seeing in this chart today, in all of these charts today. The only question is, and let me annotate this really quickly for you, are we going to get lucky here, and maybe will we find, support at the 2850 level, which is about right in there. There's, again, some shorter-term support at 2800. Or are we going to fall lower? We know we've got some support around 2630. So these are the areas that if you are long this market, you may want to put some stops in here somewhere around 2850, 2800. And then if we break beneath those areas, of course, we might stop at 2750 or 2700. But really, 2630 would be the next downside area that I would expect us to fall to if indeed we break beneath this 2800 level. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. Thank you for watching today's video. Before you leave, don't forget to subscribe to this channel. Please give me a thumbs up on this video and check out my other YouTube videos. I have a lot of great videos on my YouTube channel. And if you would like to learn more about how simple market signals can help you in both up and down markets, you will want to watch these videos that are linked in the description box below this video.